What does it mean to rebalance your investments? How often should you rebalance, if at all? And what earns a better return, a 401k or an IRA? We'll answer these questions and more on this, the 51st episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Welcome to the 51st episode of the DoughRoller Podcast. I'm Rob Berger, and I'm happy that you're here. I want to give a big thank you to the folks that have been listening to this podcast. It has been growing beyond anything I could have imagined. The number of email that I get from folks with questions or suggested topics is just it's been a lot of fun. It's been at times somewhat overwhelming, but I think I've managed to respond to every email I've received. I had a bit of an email snafu trying to integrate Gmail with Mac's mail program. I don't think they like each other. So I'm back to just using Gmail online. So I think I've got that figured out. But if you've emailed me and it's been a couple of days and I haven't gotten back to you, please don't feel as if I'm ignoring your email. It's probably that I haven't seen it. So if you don't hear from me in a couple of days, just ping me again with another email. Don't be shy. I do respond to every email. I know that there are a lot of questions out there. Money and finances are just a lot more complicated than they were a generation ago, a lot more complicated. And, they're complicated for me, and I kind of live and breathe this stuff every day. So for those that want to have a little more fun in life than dealing with what a Roth IRA is or all the other kind of crazy issues we have to deal with, feel free to shoot me an email. I'll do my best to help you out. Oftentimes, it's just sending you a link to an article. I keep a ton of resources that I've just gathered over the years of blogging, and I sort of catalog them and save them primarily through the use of Evernote, which is a great tool. And so a lot of times my response is, hey, it's a great question, and here's a fantastic article from the Wall Street Journal or Vanguard or Morningstar or wherever, and they address that very question, and it's an authoritative source. Here you go. Sometimes it's a reference to an article I've written in the past or a podcast, but whatever your question is, don't hesitate to email me, dr@DoughRoller.net, and if I've not responded, shoot me with another email in a day or two, and I'll definitely get back to you. Okay, so today we got a great show for you, starting a two-part series on how to rebalance your investment portfolio. And if you're listening and you're saying to yourself, I have no idea what that means, don't worry. It's very simple. We'll walk right through it. Today we're going to look at strategy, sort of high level, how you should think about rebalancing your portfolio. And then in the next episode, podcast 52, we're going to look at the specific tactics, how you actually go about doing it, how you go about rebalancing your portfolio. So before we get to the part one of rebalancing, though, let's first cover the money tool of the day. And this relates to collecting coins. You may have heard my previous podcast on how to value a coin collection. That was podcast 47, DoughRoller.net /podcast 47. And it was about different tools you can use online to figure out what a coin collection is worth. Maybe you have some old coins lying around the home. Perhaps they've been passed down for generations. You want to get a sense as to what they're worth. You can check out podcast 47. Today's tool of the day is really aimed for those that are more collectors. And it's a tool that a good friend of mine made me aware of. I didn't even know he collected coins. It's funny, I'd mentioned that I'd gone to the Baltimore Coin Show. And my wife and his wife are friends, and they started talking and then found out that he collects coins, and he's a serious collector. I'm not, but he's a very serious collector. And the tool that he uses to track all of his coins is called US Coin. Pretty simple. It's a program that was developed by a company called SaintSoft. And if you just Google US Coin for the Mac, they have a Windows version as well. They also have a version for the iPhone and the iPad. But it's a very inexpensive program. I think you can get an iPhone or iPad version for just a couple of bucks. I paid for the desktop version for the Mac. I think it was $19.99. And what it allows you to do is keep track of all your coins. You can include pictures of your coin. It has a whole database of types and issues, so it's very easy to select which coin you have. You can track whether it's graded and by whom, where you bought it, how much you paid. You can track the current market value, so you can see your gains and losses on your coins. I don't view mine as an investment per se, although I don't have that many to begin with. But you can track the current market value of the coin. Compare that against what you've paid for it, so you can check your profit and loss on your coins. It's a great little program. I've just started using it. I found it to be very easy to use, particularly the desktop version. Very easy to use, and I can back it up to Dropbox and then restore all of that data on my laptop, or again through the iPhone or iPad app. So very easy to use. If you're interested in tracking your coin collection, check it out. At least from what I've seen so far, I think it's one of the best ones out there, and it's very reasonably priced. So that's US coin. It's by a company called SaintSoft, and give it a try if you use it, or if you have other tools that you use to track your collections, whether it's coins or stamps or any other collectibles. Shoot me an email. Let me know what software you use. I always like to learn about new tools that make finances easier and, frankly, in some ways, even fun. At least I think this stuff is fun. And so if you have other tools, other software apps that you've used, I'd love to hear about them. Okay, let's get to rebalancing. So let's first start with very basically what's it mean to rebalance your investments. So if you've been following along these podcasts, and particularly the 31-Day Money Challenge, you know that we covered asset allocation. And if you are not familiar with that, I would highly recommend that you go back to podcast 25. That's DoughRoller.net/podcast 25. And that's where we talk about creating an asset allocation plan. And then in podcasts that follow, we talk about picking mutual funds and investing costs and all that sort of thing. But recall that with an asset allocation plan, the idea is for you to decide, all right, how much of your money do you want in stocks? How much do you want in bonds? And for the stocks, how much do you want in U.S. stocks? How much do you want in foreign stocks, maybe small cap stocks, emerging markets? Do you want anything in REITs, which are real estate investment trusts? And so you decide ahead of time, before you even pick your mutual funds, what your asset allocation is going to be. And you may recall that in podcast 49, just a few days ago, we talked about how much should you have in stocks and how much should you have in bonds. And really, the better question isn't how much should you have, because there's no one right answer to that, but rather, how can you decide what's best for you when you're allocating your investments between stocks and bonds? And so for today, let's just assume that you've decided that you want 70% of your retirement investments in stock mutual funds and 30% in bonds. All right, well, as you start to, as you create that asset allocation plan over time, as the stock market moves stocks up and down and bonds move up and down, and your portfolio is going to drift away from that 70% stock and 30% bond allocation. You may find after a month or 3 months or 6 months or a year that lo and behold, when you look at your account, you don't have 70% in stocks now, but now you have 75% in stocks. And of course, that means that you only have 25% in bonds. Well, that's not your plan, right? Your plan was 70% in stocks and 30% in bonds, again, using that as an example today. So your asset allocation plan has gotten a bit out of whack. And so rebalancing is nothing more than correcting that. And we'll talk again specifically tomorrow about the tactics as to how you might do that. But the idea of rebalancing is say, no, I want a 70% stock, 30% bonds. Stock market's been on a tear, so my asset allocation has gotten a little bit out of what I'd planned. And so that's no good. So I'm at 75% stocks now. I want to get back down to my plan, 70% stocks, which means I've got to decrease my investments in stocks and increase my investments in bonds. And that's what rebalancing is. And I've kind of a funny story. A very good friend of mine, his name is Dave, and I've known Dave and his wife and his family for a very long time. And a very smart guy. He's an engineer, so he's got that. He's a software engineer, so he's got that precision about him. And we were talking about asset allocation, and he had emailed me to say, I'm trying to get the perfect asset allocation. I'm trying to get it, I don't remember exactly what his was, but we'll just go with 70% stocks and 30% bonds. He was saying, Rob, I want it perfect, right down to the penny. But he was struggling because, like probably a lot of you, he had 401k, had IRA. You may have a spouse that has a 401k or an IRA. On top of that, you may have some money in taxable accounts, and they're all invested in different funds. And of course, your 401k may not have all of the investing options you wish it did, and so you have all this money spread around, and you're trying to get so much in stocks and so much in bonds and maybe a little in REITs, and it's hard to get it right down to the penny. And he was sort of lamenting that, and I said, well, Dave, look at it this way. Let's assume you could. Let's assume you got your asset allocation down perfect, right to the penny. In our example, you had exactly 70% stocks and exactly 30% bonds. That's great, but what happens the first day the market opens on Monday? Well, stocks are going to move one direction or another, bonds are going to move in one direction or another, and in 5 minutes, your asset allocation is going to be off by a little bit. Probably not a lot in just 5 minutes, maybe not a lot in a day or a week or a month or even 3 months. But as more and more time goes by, it's going to be drift away from your asset allocation plan more and more and more. So one of the things I was telling Dave is, look, this is not an exact science. Even if you're have an allocation at 70% stocks, it's not the end of the world if all of a sudden, because of market performance, you now have 71% in stocks. But of course, that raises a question, and that is, well, wait a minute, that's fine, but how far should we let it move away from our plan, our asset allocation plan, before we take action? Well, we're going to talk about that today, but that just gives you an idea generally of what rebalancing is. It's looking at your investments, seeing how they've performed over a period of time. They're going to move up and down. Stocks will move up or down. Bonds will move up or down, and they'll move away from your target asset allocation plan. Rebalancing is nothing more than bringing them back into line, bringing them back into the plan that you had set for your investments to begin with. So that's what rebalancing is. Now, the next thing I want to talk about is why it's important. And if you get anything from today's podcast, this is critical. Rebalancing is not about maximizing your returns. Let that sink in for a minute. It's not about maximizing your returns. Now, that may seem kind of odd. It's like, well, wait a minute, Rob. I mean, if rebalancing is not going to maximize my returns, why in the world would I bother rebalancing? Well, the answer is to minimize risk. Now, let's think about this for a moment. The riskier assets, stocks, for example, will over time have higher returns over the long period, and the less riskier assets, like bonds, will again over the long term not return as much. We know that, right? Now, of course, we could take that thinking to an extreme and say, okay, well, then I'm just going to have 100% stocks. Well, if you listen to podcast 49, you'll understand why I think for most people, that's probably not the best option. Theoretically, mathematically, historically, it will result in higher returns over a long period. But to attain those returns, you've got to be willing to live through some really ugly markets. And most people are just not willing or able to watch their portfolio drop by 30, 40, 50%. They just can't do that. And that's what you would have to be prepared to do with a 100% stock portfolio. Okay, well, let's bring this back to rebalancing. Imagine a portfolio of, again, 70% stocks and 30% bonds. What's going to happen over time? Well, over time, the portion of stocks is going to grow because over time, stocks return more than bonds. It may take a year, 5 years, 10 years, 20 years. But what's going to happen over time is that asset allocation, that portfolio, the stocks are going to go from 70 to 75% to 80% to 85%. Given enough time, the stocks will probably go close to 100%. So now let's imagine you don't rebalance. Over the long period, you'll actually probably have higher returns by not rebalancing. Of course, to achieve those returns, you're going to have to assume a lot more volatility, a lot more risk. Why? Because your portfolio, the amount allocated to stocks is going to move up and up and up. So that brings us back to the original 70% versus 30% asset allocation. Why did we pick that to begin with? Now, again, I'm using that as an example. Your asset allocation may be a little different, but ultimately we are picking a certain asset allocation because for a couple of reasons, right? We're looking at risk, what we can tolerate. We're also looking at returns and what we need to achieve our financial goals. And if we have decided that a 70% stock, 30% bond asset allocation is the sweet spot for us, we can handle that amount of volatility, and it will, as best as we believe, it will get us the returns we need to achieve our financial goals. That's why we set it there, right? Or again, whatever asset allocation you've chosen. We don't want that to drift up and for us to incur greater volatility and greater risk than we can handle. And that's exactly what will happen if we don't rebalance. Rebalancing, by bringing our investments back in line with our original asset allocation plan, is not designed to maximize returns. If you want to do that, forget rebalancing 100% stocks. Again, in podcast 49, I've told you why I think for most people that's a mistake. But if you're into maximizing return, you don't ever have to rebalance. You just be 100% stocks. But I think for the vast majority of us, no, we need a little continuity in our portfolio. We can't handle that kind of risk, so we add a certain amount of bonds into our portfolio. And by rebalancing, we keep that asset allocation at that plan, again, whatever it is for us, and that helps us keep our portfolio in line with the risks and returns, the risks that we think we can handle and the returns that we need. I'll say one final thing. I talked in podcast 41 about Warren Buffett's asset allocation plan for the investments of the money he plans to leave to his wife, and even he had 10% of that portfolio in bonds. So that's why rebalancing is important. I hope you followed all that. If you didn't, feel free to shoot me an email. But again, if you have a certain portfolio, certain asset allocation, and you don't rebalance, eventually the riskier assets over long periods of time will return more, so they will end up taking up more and more of your portfolio. That could increase your returns, but it will also increase your risk beyond what you were willing to accept when you originally set your asset allocation plan. So that's why rebalancing is important. It's not to maximize returns. It's to keep your risks in line with your original asset allocation. Now, before I move away from this, why rebalancing is important, which is point 2 of 5 that I'm going through. Before I move on to point 3, I want to mention a resource to you. I will link to it in the show notes. It's by Vanguard. It's a white paper. It was written in July of 2010, and it's best practices for portfolio rebalancing. Now, you may not want to dive into the details of this white paper, but if you do, I think it is a very well-written paper. And one of the things it talks about is what I've just described, is that a portfolio that is not rebalanced will almost always, in the long term, return more than a portfolio that is rebalanced. But again, you'll incur a lot more risk. And in this white paper, it looks at some data going all the way back to 1929, and it goes into a lot more detail about different rebalancing approaches. We're going to talk about some of them today. But it shows you this difference between rebalancing and not rebalancing, and it underscores why you rebalance, not to maximize returns, but to minimize risk and to keep your portfolio in line with your original asset allocation plan. By the way, one of the authors of this white paper was Colleen Giaconetti, and you may recall that she was on the show not that long ago, just a couple of episodes ago. Let's see, podcast 46, and an excellent white paper. I'll link to it in the show notes. Okay, so let's move on to point 3, and that is, all right, fine. I understand what rebalancing is. I get why it's important. It's not to maximize returns, but to minimize risk in line with our original asset allocation plan. Got that. All right, fine. So how do we do it? When should we go about rebalancing? Well, there are a number of different approaches to rebalancing your portfolio. I want to talk about what I consider the 3 primary approaches. The first is based on frequency. You simply decide that you will rebalance your portfolio every month, every 3 months, every 6 months, once a year. Large pensions might rebalance daily. But in this case, it's simply a question of how much time goes by. So that's the first approach. And we'll talk about some specifics as to what might be reasonable in just a minute. But that's the first approach. It's based entirely on frequency. The second approach would be based on threshold. So in other words, it's not based on any particular time. You simply wait until your various asset classes get out of whack, so to speak, by a certain amount. So for example, using our somewhat simplified asset allocation plan of 70% stocks and 30% bonds, you may set a threshold of 5%. So when either asset class gets above 5% from its original starting point. So if stocks went to 75%, or if bonds went to 35% from 30, that would trigger a rebalance. And so that's based on a threshold, simply getting your asset allocations beyond your plan by a certain percentage. Now, there's a big downside to this approach, and that is you have to be checking your asset allocation pretty frequently to know when you've crossed that threshold. You may not have to check it daily, but particularly when there's a lot of ups and downs in the market, you may be needing to check your portfolio weekly or monthly, and that may be more than you want to do. And but that's sort of one of the downsides to the threshold approach. But that brings me to the third approach, the one I use, and that's a frequency and threshold. You combine them both. You say, well, okay. One, I'm only going to check to see if I need to rebalance every month or quarter or semi-annually or annually. And when I check my portfolio, I'm not going to automatically rebalance it. I'm only going to rebalance it if it passes a certain threshold, again, like 5%. So you kind of combine frequency and threshold into one approach to rebalancing. That's what I do. In my case, I look at my portfolio monthly, which I think for most people, and frankly, even for me, is probably excessive. But since I enjoy it and I blog about it and I podcast about it, it's just something that kind of a habit I've fallen into. So I check my portfolio every month. That's the frequency that I have. But I also have a threshold, and that's usually 5%. So if my stock allocation is 80%, my bonds are 20%. So I would have to see stocks above 85% before I would rebalance. And so that's the sort of the third approach, to combine the two. I think a frequency approach is fine. If I were going to do just a frequency approach, I probably wouldn't look at my investments for rebalancing purposes more than every 6 months, and I might even only do it once a year. In frequency and threshold, I end up not rebalancing as much, right? Although I'm looking at my investments every month, that doesn't mean I'll rebalance. They've got to cross that 5% threshold. And so many, many months can go by, depending on what the market's doing, without having to do any rebalancing. But those are sort of the three high-level approaches to rebalancing. Again, frequency, threshold, or a combination of frequency and threshold. Now we get sort of down to, okay, well, what's the best approach for you? And of course, there's no one right answer. Just like with asset allocation, there's no one right answer to what your asset allocation should be. But I want to give you a couple of things to think about as you're deciding what's best for you. And the first is, I think it's absolutely critical that you have a plan. You need to set out now what your plan is going to be for rebalancing your portfolio, whether you take a frequency approach, threshold, or frequency and threshold combined. And whatever your frequency is, again, maybe it's twice a year, whatever your threshold is, you need to have that plan now. And that's important. And it's important because if you don't do that, what's going to happen? Well, stocks go up like they did last year. And I mean, who wants to sell their stocks to rebalance, right? They're on a tear. They're doing great. They were up 32% last year. Sure, we had a tough January, but now they seem to be going up again. And so without a plan, you kind of let it ride until what happens? Eventually, it's going to go down. And at that point, your asset allocation plan, I mean, you almost throw it out the window. I mean, now you're sort of market timing. And the same can happen when stocks go down. If you don't have a plan and stick to it, are you going to be willing to rebalance when stocks are down? Maybe your bond portfolio has grown. In our example, you started at 70-30. Maybe now, think back to 2008 and 2009. Now maybe your portfolio is down to 60-40. But let's think about this. To rebalance, you've got to potentially sell 10% of your bond portfolio and invest in stocks at a time when everyone's afraid. And we're in the middle of a financial crisis and there's unemployment. And you're gonna invest in more stocks. They seem to go down every single day. Well, yeah, that's exactly what you do. But I think you can't. You're going to find you're going to find that it's very difficult to do if you don't start with a plan. So whatever you end up deciding for you, I think it's important to know that now. Decide on that plan now and stick to it, regardless of whether the stocks and bond markets are going up or down. The second factor you need to consider are costs. There are costs associated with rebalancing, and we're going to talk more about those in the next podcast 52. But it's important as you think about what approach you want to use for rebalancing. A couple of the big costs are taxes, to the extent that some of your investments are in taxable accounts. Trading those investments to rebalance your portfolio can trigger significant taxes. Now, tomorrow, I'll give you some strategies to avoid that, in the next podcast, I'll give you some strategies to avoid those taxes. But that is one thing to consider, are the tax consequences of rebalancing. The other thing to consider are any fees that you have to pay. Typically in a 401k, there won't be any fees to buy and sell stocks, typically, although you need to confirm that. Within IRAs and taxable accounts, depending on where you have your accounts, there could be. Again, depends on if you're investing in individual stocks or ETFs. There could be any number of fees for buying and selling these investments to rebalance. And then, while maybe not technically a cost, but there is just the time and aspect of all of this. Again, you may have 401k, your spouse may have a 401k, multiple IRAs, taxable accounts. It's a real headache to rebalance. And so there is some costs involved in the sense of just your time and headache. It's a bit of a hassle. And I think that's worth considering. I think in my case, rebalancing potentially every month is probably on the extreme side. I do it because I blog and write about it. But I think for most people, rebalancing either once a year or twice a year is probably enough, with or without a threshold. But again, you have to decide what's right for you, and I think it's worth thinking about the time and energy involved in doing this. Okay, so that gets us to the fifth and final point, and that brings me back to this Vanguard white paper, this best practices for portfolio rebalancing. They go through an entire analysis of data going back to 1929, and what they conclude is that for most investors, it's perfectly fine to rebalance either annually or semi-annually, with a threshold of about 5%. So in other words, once or twice a year, you'll look at your investments, and if they've moved away from your asset allocation plan by more than 5%, you'll rebalance. And what Vanguard found is, yes, you could do this monthly, you could do it quarterly, but when looking at the data over long periods of time, it really doesn't have a significant impact on the risk of your portfolio. Remember, that's the key element for rebalancing. But even if you want to focus on returns, rebalancing monthly versus quarterly, for example, won't have a significant difference in returns as compared to rebalancing semi-annually or annually. And so I think for most people, that is a good approach. Again, you've got frequency and you've got threshold. Frequency once or twice a year, and threshold of 5%. So again, in the case of a 50-50 asset allocation between stocks and bonds, if either asset class went to 55%, you would rebalance. In the case of a 70-30, the way I would approach it, you could look at just an absolute 5% if your stocks went to 75 or down to 65, or you could even take 5% of the individual asset class. And that can, I should add this, if you have a more complicated asset allocation plan, you may have, say, for example, 10% in REITs. Well, it's unlikely that your REITs are going to fall to either 5% or grow to 15%. That would take a pretty significant either loss or increase in REITs for that to happen in your portfolio. So what I do in that case is look to a change of 25% of that 10%, if that makes sense. So in other words, in the case of an asset class where I've allocated 10% of my investments, I'll look for that asset class to move one way or another by 2.5%. So if it goes down 2.5% or up 2.5%, I would rebalance. That's the approach I take. So I take it. I guess it's somewhat more complicated, although I have more asset classes than I know a lot of folks do. But if you're trying to keep it simple, then I think Vanguard's approach is terrific. Check it once or twice a year and look for a 5% threshold. And I think it's a great way to rebalance. Again, the key is to pick your approach and stick with it. Okay, so as I mentioned, in the next podcast, we'll cover the specifics. And this is something I've been focusing on and talking to people where, we talk at sort of a high level like we've done today, but then it's like, okay, that's fine, Rob, but how do I actually do it? It's one thing to talk about it at a high level, but then to log into your 401k or IRA and start clicking buy and sell links to make these big trades, things, it gets a little nervous, right? And I understand that. So in the next podcast, I'm going to walk through some specific tactics as to how you can actually rebalance a portfolio while being mindful of the tax consequences, the costs, and just the time element. Okay, now we're to the money tip of the day, and it relates to the third question I asked at the beginning of this podcast, which, if you were paying attention, some of you might have thought that it was a rather odd question. I'm going to remind you of what it was. What earns a better return, a 401k or an IRA? And that question actually came to me from a good friend of mine who is young. He's just out of college. He's got a job, doesn't have a 401k yet or an IRA, but is very curious, asking a lot of questions, which is great. I mean, that's where you start. And the other day he asked me, he goes, so actually he asked it a little differently. He said, what pays a higher interest rate, a 401k or an IRA? And I said, well, interest rate, do you mean like interest or dividends or just which one returns, has a better return? He goes, yeah, that's right. Which one has a better return, a 401k or an IRA? And I thought, I'm going to make this a money tip of the day because I do think that folks can confuse 401ks and IRAs on the one hand and your actual individual investments on the other. So let's think of a 401k and an IRA. They are not investments in and of themselves. They're simply types of retirement accounts that give you or can give you certain tax advantages, right? You can put aside pre-tax dollars and they can grow without paying taxes, and then you don't pay the taxes until you start using the money in retirement. Or if they're Roth 401k or Roth IRAs, you do pay the taxes before you invest in them, but then that money grows tax-free, and when you use it in retirement, you don't pay any taxes on the returns that you've received. But those are account types. Those aren't investments. You can think of a 401k and an IRA as buckets, and the real question now is, what are you going to put in those buckets? And with a 401k or an IRA, as you probably know, you can invest in various mutual funds, which is, I think, probably the norm. Although IRAs, you can open up at brokerage accounts. I've done that. I had a SEP IRA at Scottrade, and I invested in individual stocks. You can invest in individual bonds. I think most people probably invest in mutual funds and ETFs. But when you think about how a 401k or an IRA is going to perform in terms of returns, your real question isn't how is the 401k or IRA going to perform, but rather how are the investments that you choose to put in to each of those accounts going to perform. And so it's an important distinction, and I think it's an important concept to understand. 401ks and IRAs are just account types that have tax advantages associated with them. How your 401k or your IRA actually performs will depend on the investments that you make within those accounts. And you think about it, it's not uncommon for folks to say something like, my 401k is doing really well, or my IRA is not doing well, whatever the case may be. But of course, it's not the IRA or 401k that's performing or underperforming, right? It's the investments that you place within those accounts that are either doing well or perhaps not doing so well. And so I got that question from a good friend. I thought I'd make it the money tip of the day to help you understand, for those perhaps just starting out, what 401ks and IRAs are on the one hand versus the actual mutual funds, ETFs, and other investments that you invest in within those retirement accounts. Hope that helps. As always, please send me your questions, as I mentioned at the top of the show, dr@DoughRoller.net. I love to hear from you. And until next time, remember, the best thing money can buy is financial freedom.